Hi everyone, buyers agent Jay Pace here for Providence Property Group with a market update for the month that was May 2022. So as expected, the Reserve Bank of Australia has lifted the official cash rate for the second straight month to address higher than expected inflation, while consumer confidence fell amid cost of living concerns. Although the size of the increase definitely did surprise economists, the RBA Governor Philip Lowe announced an increase of 50 basis points to 0.85% following the board's June meeting. A 50 basis point increase is probably what we would consider a knockout bid in the buyer's agency industry. So I think there's a bit of strategy here. We do know that their cash rate target is at 2%. They're currently at 0.85%. So from doing a previous increase of 0.35% and then doing a second increase of 0.5%, I think the RBA is trying to puff out its chest a little bit and show people that they're not mucking around. But I do definitely think that if the RBA starts to see that the economy starts to struggle from these increases in interest rates, do not think for a second that the RBA won't stop increasing interest rates and might even actually start to reverse them. So they're just trying to see how the market kind of reacts to these things. It's not an exact science for the RBA. They're trying to figure out what the consumer sentiment's going to be like. But they have said what they want to do. But what they do is going to be a completely different story depending on the reaction from the market. Now, this is only the second increase in the official interest rate since November 2010, which lifted the cash rate from a record low of 0.1% to 0.35% in May, and now again up 50 basis points to 0.85%. So this increase in interest rates by the board is a further step in the withdrawal of an extraordinary monetary support that was put into place to help the Australian economy during the pandemic. So in the statement, the RBA governor noted that the resilience of the economy and the higher inflation means that this extraordinary support is no longer needed, given the current inflation pressures in the economy and the still very low level of interest rates. The board's decided to give us this 50 basis point hike. Now, residential real estate definitely does still underpin our Australia's wealth. You can see $9.98 trillion worth of real estate there compared to superannuation, listed stocks and commercial real estate, and our outstanding mortgage debt is only $2.1 trillion, so still quite conservative in regards to our debt to asset ratio there. Now let's talk about winners and losers for the month. The latest hedonic home value index numbers show the top three growth capitals for the month were Adelaide, Brisbane and Perth. It's almost like I said that was going to happen last year. Now you'll recall in previous videos that I talked about how the investment dollar is portable and we would see money leaving the larger capital cities and finding its way to second tier cities like Brisbane, Adelaide and Perth. That trend is well and truly underway. We believe that these cities will outperform Sydney and Melbourne and Canberra for the next 5 to 7 years. Sydney's been recording progressively larger monthly value declines since February. Last month we saw a further decline of 1% since peaking in January. Sydney housing values are down about 1.5%, but remain 22.7% above pre-COVID levels. So again, there's nothing to panic about. There's not going to be a massive sell-off, but we're just not going to see these double-digit returns for places like Sydney and Melbourne anytime soon. Comparatively, Melbourne's fallen across 4 of the past 6 months. And in May, we saw a 0.7% drop, while Canberra registered a 0.01% decline, which is nothing. I've never liked the term two-speed economy because I see that there are 3 ways a market can go. So it can go up, down, but it can also go sideways. Sydney and Melbourne have been the first capital city housing markets to record negative monthly growth rates this year, joined most recently by Hobart in April. Its first fall after 22 consecutive months of growth. Now, 32% of suburbs in Sydney saw a decline in housing values for the March 2022 quarter. Here we can see the decline of the Sydney and Melbourne markets contrasted by the rise of Adelaide, Brisbane and Perth. And I mean, it makes total sense here. The price points for Sydney and Melbourne are way too high. So is Canberra. But also with Melbourne and Sydney exclusively, I guess, their rental yields are also the lowest in Australia. And with rates going up, with interest rates going up, people need to make sure that if they're buying a property, that the rental yield they get in is going to help them manage the cost of holding on to that asset. And places like Adelaide, Brisbane and Perth just offer much higher and more attractive rental yields and lower entry price points. So it's a no-brainer that we're going to start seeing money pour into these particular capital cities for this later part of the cycle. And I really do think that they're going to drive the majority of the growth for the rest of this cycle. Now, red-hot regional Australian property markets are showing signs of slowing down despite outpacing capital cities due to chronically low listings and sustained buyer demand. Dwelling values across the combined regions jumped by 23.9% in the year to April 2022, outpacing the combined capital city dwelling growth rate of 14.6% for the same period. So 23.9 versus 14.6%. That's quite a gap. According to CoreLogic's latest regional market update, the growth rate across Australia's 25 largest non-capital city regions has slowed from its peak of 6.6% in April to 4.7% in the 3 months to April 2022. Now, for those of you considering buying regional, I offer you this information. The population of regional Australia grew 70,900 people during 2020 to 2021, in contrast to the decline of 26,000 people for the capital cities, according to the figures released today from the Australian Bureau of Statistics. But what I do think is quite interesting here is that this is the first time it's beaten capital city populations since 1981. Okay, so what that tells me is that if I bought in a regional area hoping regional was going to go up, I would have been sitting on that for over 30 years with really no growth. And now I've seen some growth. Don't let that fool you and make you think, well, now's a good time to start buying regional. It was a fluke. No one knew it was going to happen. No one knew that the pandemic was going to cause people to work from home and regional areas and holiday areas were going to go up so significantly. It's not going to happen again. The data is not there. So if you're looking to buy regional, you may get a very good rental yield for a certain period of time, but your vacancy rates are going to be volatile, and capital growth, it's probably not going to go anywhere for a long time. So be very, very cautious. Now, the trend in advertised stock levels helps to explain the weaker conditions across Sydney and Melbourne. So nationally, advertised stock levels remain 10.3% below what we've seen this time last year and 28.4% below for the previous 5 years. However, inventory in Sydney and Melbourne are now higher than 12 months ago and against the 5-year average. So Sydney advertised listings are about 5.1% higher than a year ago and 1.5% above their 5-year average. Similar to Melbourne, advertised stock levels are up about 1.3% on last year and 8.1% average over the past 5 years. So I think that's quite interesting that we're seeing those markets where they're declining, we're starting to see more product coming up for sale. If you like what you've seen here, and obviously you want to be kept in the know with the Australian property market, make sure that you like this video, subscribe to our channel, and then you can see a bit more there. I want to thank you for your time today, and we will see you next month.